All right, so we're looking at Chapter 3, and Chapter 3 is where we're going through and talking about something called adjusting the accounts. Now, what we've done up to this point is we've analyzed the transactions and we've seen what economic items needed to be recorded, and then we've done journal entries to post them to the journal, and then we've posted those to the ledger. What we're talking about here is going through and making adjustments for items that aren't recorded as part of the normal transactions that happen during the month. And over on page 96, they talk about the accrual basis of accounting and the reason why we have to do these adjusting journal entries. Basically, that's what Chapter 3 is going to talk about. It's going to explain the accrual basis of accounting, the reason for the adjusting journal entries. We're going to go through and prepare adjusting journal entries for both accruals and for deferrals, and talk about what those are. And then we're going to talk about something called the adjusted trial balance, which is a way that we check at the end to make sure everything is done. So when we talk about the accrual basis of accounting, we're talking about going through and recording things, events and transactions, not necessarily when the cash happens, like most of us do when we record in our checkbooks, but when the actual economic event occurs. And the reason that we do that is because sometimes the cash and the economic event are disconnected. And we have to go through and put the economic effect of the transaction in the period in which it occurred, not when the cash occurred. That's for something called the idea of looking at the different periods, and they talk about the time periods for accounting, so we can see if this month had a good income and revenue, if this expense had a good that next month had a good income and revenue. We try to figure out and match it to the appropriate period. So accrual accounting is where we go through and we record items in the periods in which the event occurred, not when the cash occurred. They talk about the revenue recognition principle in 97, and that's the idea is that companies record the revenue in the accounting period in which the performance obligation is satisfied. In other words, the period of time in which they've actually earned the money, even if the cash hasn't happened yet. The expense recognition principle, which is also called the matching principle, says that we match the expenses with the revenues that were generated. So if we used expenses to generate revenues, we match the expenses in the same time period that the revenue was generated. So if we do some work and our employees are doing the work and we're going to pay the employees, but we aren't going to pay them until the next month, we want to make sure that the expenses for those employees doing the work are matched in this month when we did the work and received the revenue for doing that work, not in the following month when they're actually going to be paid. So the matching principle says we have to go through and record things. So that leads us to the need for adjusting journal entries, which are basically where we need to go through and put the revenues and expenses in the right time period. Now, adjusting journal entries are always going to affect, on one side, a revenue or expense account, because we're trying to properly place revenues or expenses in the right time period. The other side of the entry is always going to be affecting an asset or a liability account. And there's two different types of adjusting journal entries, two major categories, okay? And they have them listed on the bottom of page 98, deferrals and accruals. I like to look at them this way, okay? Deferrals are what happens when the cash happens first and the event happens later. So cash first, the economic event is later. Accruals are just the opposite. The event happens first, and then the cash follows later. And this can happen for both revenue items and expense items. On the deferrals for revenues, for example, we might go through and actually receive a prepayment from a customer who is going to pay us for doing some work that we haven't earned yet. So we have to record an obligation to do that work, a liability, but of course we also show the increase to cash. You can also have a deferral on an expense item. That's where we go through and we make a payment, like a prepaid item, and we're going to use that up later. So maybe we pay our rent in advance 2 months to our landlord. Cash goes out, so an asset is decreased, but then we've also have a prepaid asset that we can use later on to offset an expense. On accruals, it's the opposite. We're going to have the event first and the cash is going to follow later. So on a revenue, that's more common where we've done the work and we're going to send a bill out, but we haven't gotten it done by the end of the month. So we record an account receivable as an asset, and then we show an increase in the revenue account because we did the work, we've earned it, people owe us, but they aren't going to pay us till later. We also have accruals for expenses. That would be where we've ordered something or we've got something, some service, but we haven't paid for it yet. So a good example are wages for employees. Maybe we pay people every 2 weeks, and so at the end of the month we need to show the expense for wages for, say, the month of September, but people aren't going to be paid until the 5th of October. Well, at the end of September, we've got to record that period of time that the people work for us in September, so September is properly recorded with the expenses, even though they're not going to be paid for those days until October. So we would record a liability in accounts, or sorry, in the salaries and wages payable, and then we would record the expense to put the expense in that time period. So again, every adjusting journal entry is going to have one side an adjustment to a revenue or an expense account, and the other side an adjustment to an asset or liability account. You have a lot more of the accruals than you do of deferrals, because it just works out that way. There's a lot more people who want to get something now and pay later. So as a result, that's the more common one than the deferrals. Now, over on page 100, they start walking through different examples of these types of accruals. And you're going to need to know how to record the journal entries for these. So what I'm going to do is I'm going to walk through them, but I'm going to use the T accounts because I find analyzing accounts with T accounts works pretty well. It makes it easier for me to be able to understand what the account is and what it should be. Keep in mind that if we don't record these, we're going to have our financial statements off balance. The income statement and the balance sheet are going to be incorrect. So you're going to need to know the effect of those as well. So let's just take a look over on the prepaid expenses. And on page 100, the first example they have are supplies. And that's a pretty common one. Supplies, you buy in advance and then you use them up, but nobody keeps track of them when you're going through and actually using them up. So what we're going to do is we're going to go through and record the transaction that's shown here. So let me do supplies first. So let's do the T account so we can see the transactions and how they occurred. So this is supplies, it's the asset account. And they tell you that on October the 5th you went through and you purchased $2,500. So you went to Staples, you bought a bunch of stuff, you put it in the cabinet, and then all during the year or during the month people are going through and they're taking stuff out. They're using toner, they're using paper. You don't keep track of that because you don't want to have a journal entry every time somebody goes to get an eraser. So what you do though at the end of the month, October 31st, is you go and you count what's in the cabinet and you realize there's only $1,000 worth of supplies left. Well, what you need to do then is to record what's been used up during the month of October. And so we're going to have an adjusting journal entry for the difference. If we started with the 25 and we want to go down to a debit of 1,000, we have to decrease supplies. You decrease an asset by doing a credit, and the difference is the $1,500. Okay? And the journal entry that would look like that would be to supplies, expense, because we need to record the expense for $1,500, the debit, the credit, and then of course the supplies asset is reduced by the $1,500. So that will be our adjusting journal entry at the end of the month. We've used it up, but it's not going to get recorded because there were no transactions that showed that happening during the month of October. If we didn't do this, our expenses would be understated and our assets would be overstated. Okay, so those are supplies. And again, using the T account, finding out what you started with, where you ended, and seeing what you need to adjust, for me, that makes it easier. They also give on page 101 the example of prepaid insurance. So it's another example where it's a deferral. You've paid the money in first, and now you're going to use it up later. So in the prepaid insurance, what happened was on October the 4th, you went through and you paid $600 worth of insurance, just like most of us do. We pay our insurance in advance for our cars. Then they go through and they say, well, we know that that was for, looks like that was for 12 months. So we know that over time we use that up. But again, there's no cash going out at the end of the month to show what happened. So we've got to show that we've used up some of that. Well, if we have $600 for the whole year and we're going to use it up over 12 months, that works out to be $50 a month. So we need to do an HAE, adjusting journal entry, of $50 in order to show that that expense is going to be recorded. So again, this is an asset account, has a normal debit balance, so we're going to reduce it by doing a credit. And then that leaves us with $550 of prepaid insurance that's still going to be used in the future. The journal entry for this would be to go through and to record the insurance expense, because we've used up some of the insurance for $50. and then to show the reduction in the prepaid insurance asset account for $50. If we didn't do this adjusting journal entry at the end of the month, the insurance expense would be understated, which means income would be too high because we wouldn't have enough expenses, and our assets would be overstated. On 102, they talk about depreciation. Depreciation is kind of a different situation, and we're actually going to talk more about that when we get to the chapter on long-term assets. But what we're talking about there with depreciation is that we have long-term assets like plant, equipment, vehicles, things that we purchase up front, but then we are going to use up over a period of time. They decline in value as we use them, and we have to match that decline in value, that cost of using the item over the period. We don't want to just show all the expense in the time we bought it. So what we do is we actually go through and we spread it out using different methods. That spreading it out is called depreciation. We're adjusting the value down to what we think the usage, the cost of the usage has been. We don't reduce the depreciation or reduce the asset though, because we want to show it for disclosure purposes on the financial statements at its historical cost. So what we do is we use another account called accumulated depreciation, which is a contour or offset account to the asset. So what happens there, you can see they have an example on page 103, example 3.7, where they go through and they show us that we have figured out that the amount of the depreciation we need to record is $40. And we did that by going through and looking at the time period we're going to use the asset and spreading it out evenly over that period. And we'll talk about those depreciation methods in a later chapter. But just to show you the journal entry for that, in this particular case, let's do the expense side. So we have depreciation expense. And at the end of the month, we haven't recorded anything because no cash was being used, so there was no regular entry that was made during the month. But we know that we need to show the expense, and it looks like that was $40. So what we're going to do is we need to do an adjusting journal entry for $40 to show that there is a debit to the expense account. And the entry that we're going to do is going to be depreciation expense for $40 to show the expense, and then we're going to put it into the accumulated depreciation account, which is going to be used then on the balance sheet to subtract from the regular equipment or whatever the item is we're depreciating. And so that's credited. So we're increasing an expense, and then we're decreasing an asset by putting it into the contra account. And again, if we didn't do this entry, we would have expenses too low, which means income would be too high, and our assets would be too high because we wouldn't show the reduction in the value of that asset. Now, that takes us through most of the deferrals that we have to worry about in terms of looking at the expense side. Okay. Now what we need to look at is we're going to look at the revenue items, because we also have where we go through and we have unearned revenues. And again, we like this because that means our customers have paid us cash before we've actually done the work. We'd all like to have more customers like that. But unfortunately, we don't have that many. But it does occur. So they have this on 105 where they go through and they're talking about the unearned revenues. And in this particular case, we go through and we have unearned revenues. And this is a liability account because it means that we have an obligation to provide a service to a customer and we haven't done it yet. And so what they tell us is on October the 2nd, we actually get $1,200 payment from our customer. Haven't done the work, they just gave it to us. And then we go through and at the end of the period, on the end of October, we look at how much work we've done. So we've been working on this project during the year. And we figure out that we've done about $400 worth of work. How do we know that? Well, we probably kept track of our invoice of our time and everything. We haven't billed the customer because the job's not done. But we want to show that we've done $400 worth of work during the month of October, which means we still have $800 worth of liability of work that we have to do in the future. Now again, so we haven't sent the bill out. Nothing's happened, no cash has changed hands. So in order to record this properly, we would have to do a journal entry that would look like this. We, in this case, would go through and we would debit the unearned revenue, which is the liability, because we want to debit it to reduce it. So you reduce a liability by hitting it with a debit. And then we're going to record the, what kind of revenue do they use here? Service revenue. So we actually did some work, so we want to show it on our income statement for this month that we actually had completed some work, or done some work. We hadn't completed the job, but we did some work. So we're going to show $400 as a credit to put it into the revenue account and increase that. Now again, if we didn't do this, our liabilities would be overstated and our revenue would be understated, and that means income, then net income would be understated as well. So these are the deferral accounts that you have on the expense side and on the revenue side. Again, those aren't as common and they may be a little bit more confusing. Probably the ones you're more likely to see are going to be the accruals, adjusting journal entries for the accruals. So let's take a look at those. The first one they talk about, that's an accrual, and again, this is going to be focusing on I guess we're going to do the revenue side, is we're going to go through and we've done some work, but we haven't billed for it. So in this case, on the bottom of page 107, they talk about accounts receivable. So what we want to do is we want to go through and we want to show that we have an asset. People owe us some money. And so they tell us that we went through and we evaluated when we've done the work, and maybe we've completed the work and sent the bill, and we haven't received payment. Maybe we haven't sent the bill yet, but we've done the work. We have our timesheets. At any event, on October 31st, we go through and we look at this and we say, you know, we really should be paid $200. This is the amount that we've completed work on. We've earned it, and we haven't sent the bill, or if we've sent it, we haven't received it, but it still needs to show up in October as a revenue. But it's not going to show up yet because we haven't generated either a cash item, and if we haven't done an invoice yet, we haven't even generated a bill. If we've sent an invoice, probably when we sent the invoice, we generated account receivable. So this is more likely at the end of the month for jobs that you've worked on but haven't finished and haven't billed for yet. So we have to do an adjusting journal entry here to put it in for the $200 to make sure we get that revenue in October. And the journal entry for that's going to be pretty straightforward. It's going to be accounts receivable, the asset. We need to increase it by 200, and then we want to increase the revenue because we want to show that we've done the work and we're entitled to be paid for it in the future. So service revenue, and that's 200. And if we didn't record this, then what would happen is our assets would be understated and our revenue would be understated because revenue would be too low and that would make income too low. So those are accounts receivable. More likely what you're going to run into is going to be expenses, where we've gone through and we've received a service or received some benefit, but we haven't paid for it. And they talk about the accrued expenses. Again, service has been incurred, but we haven't yet paid for it ourselves. And they talk first off about accrued interest on page 108. So in this case, you go through and you have a loan that you owe the bank, and maybe you aren't going to pay it until several months later. So every month you don't send them a check. This isn't a payment like on our car where we pay every month. Here, we're going to pay it all at the end. Now, one of the things you need to keep in mind if you're doing interest payments is remember how we calculate interest. And the way that we find the amount of interest that we owe is to take the interest times it equals the principal times the annual interest rate times the time period that we're going to be borrowing the money. So in this case, they tell us that we had $5,000 that we had borrowed from the bank. We pay 12% a year for the whole year, but we don't want to record the whole year, we only record 1 month. So we're going to take that times 1/12, and that's going to be basically the same as divided by 12. That tells us that the amount of interest that we owe is $50. But we're not going to pay it until we pay the loan back with the interest later on. So what we need to do now is we need to go through and we need to record that liability. So we have an interest payable account, and doesn't have any value in it now, so we want to show that there's going to be a liability to pay $50, okay? So we have to do an adjusting journal entry end of the month for the $50. And the journal entry for that is going to be to put the $50 into an expense account to show the cost of borrowing the money. So interest expense, $50. And then again, we also want to show the liability being increased. So interest payable, $50. If we didn't do this entry, adjusting entry at the end of the month, then our interest expense would be too low, means our income would be too high, and our liabilities would be too low, so our balance sheet would be off. Another one that's pretty common that you have to record is to pay your employees for their wages, because most companies don't necessarily always just cut off at the end of the month. A lot of companies pay every 2 weeks or different time periods. So the period of time that employees are getting paid and the end of the month that you're doing for the accounting don't always coincide. So on page 109, they talk about accrued salaries and wages. And in this case, they go through and they show you the calendar there where they count up how many days from when the employees were last paid until the end of the month. And those are the days that need to be recorded in that month, because that was the month that they worked, so the expenses belong there. However, it may be several days past the end of the month before they're paid, so you need to split the days between the 2 months. So in this example, they go through and they tell us that we had, $5,000 people were paid for a 5-day work week, and then they tell us that there are 3 days in October where they work before the end of the month that they haven't been paid, because they aren't going to be paid until the 9th. So what's going to happen is going to look like this. We need to go through, we need to record the obligation, the account payable. So in this case, it's just called salaries and wages payable. And so what happens is we go through and we know on October the 31st we owed some money. We calculated it up and it was $1,200. But they're not going to get paid until later on the 9th. They're going to get paid that $1,200 plus the $800 for the month of November. So the cash isn't going to happen until down here. This is the payment. So we want to show the liability at the end of October. So what we need to do is an adjusting journal entry for the about $1,200. And the journal entry that we're going to do is going to look like this. It's going to have a debit to salaries and wages expense. To put those expenses in October for those, how many days was that? 1, 2, 3, 4, 5, 6, 7, 8, 9 days? 3 days. 3 days. They count their own calendar. 3 days. So we're going to go through and we're going to put that in for that $1,200. And then what we're going to do is then we're going to put it into the wages or salary and wages payable account to show that we owe the money. And then later on, when the payment comes out on the 9th, then we'll reduce that payable account. That's why you're going to see, basically, you'll see the debit over here on the payment when the cash comes out. See, what else do we have? Those are probably the major accruals and deferrals you're going to have to worry about. You're going to have to know how to do the journal entries, so you want to go back and practice those. On 111, they have some discussions about errors. When errors occur, you might want to go through and take a look and see how, if you have a problem, they give you some tips there. First of all, you should never have a journal entry for an adjusting journal entry to cash, because that's why we're doing them. There's no cash involved. So if you're putting cash in one of these entries, you probably are making a mistake. The other thing is you should always have one asset account or liability account on one side of the entry, and then one, or you can have several, but also you should have expense or revenue accounts on the other side. So you're always going to affect the balance sheet and the income statement. See, what else do we have? Then they go over and they talk about the trial balance. The trial balance on 113, basically the trial balance is where we're going to check things to make sure after we've done all this we haven't made a mistake. If you remember, when we do the ledger, we take all the ending balances in the ledger and we put all the debits on one side, all the assets on the other side, or all the debits on one side, the credits on the other side. We add them up to make sure we balance. That's to make sure we didn't make a posting error. We do the same thing here. In Chapter 4 they talk about the worksheet, but we put all the adjusting journal entries in, and then we post the adjusting journal entries. When we're done, we go through and we add up all the debits for the account balances, all the credits for the account balances, and hopefully they balance. If they don't, then we may have made a mistake here. So the adjusting trial balance is just an interim figure step where we go through and check to make sure we haven't done an error before we go on to the next step. You don't have to worry about the Learning Objective 5, adjusting entries for alternative treatment of deferrals. Don't worry about that. And then you get over to Appendix 3B, Learning Objective 6. This is pretty good information. You'll need to know this because this is kind of where we talk about why we do accounting. And they have a lot of concepts that are in here. They talk about, for example, what they consider to be the qualities of useful information. For information, financial information to be useful, it has to have two characteristics: relevance and faithful representation. So you can read about those on the bottom of 120. You should understand what those are and be prepared with the definitions, or also to be able to see how they're being utilized. They talk about enhancing qualities on the top of 121, comparability, consistency, verifiability, timeliness, understandability. You should know the definitions of those and how they're applied. They talk about assumptions that we use in generally accepted accounting principles: the monetary unit assumption, economic entity assumption, time period assumption, and going concern assumption. Again, you should be familiar with all of those definitions and how they're applied. Over on 122, they talk about some principles in financial reporting that we use. And they talk about measuring. We use historical cost, where we record things based upon what was paid for them, because that's an objective valuation. Sometimes you use fair value principle. That's how you look at the cost of things based upon how much they're worth at the time you're valuing them. So you should understand both of those concepts. The revenue recognition principle we talked about, that's where you record the revenue in the period in which it's earned, not when the cash happens. That's why we had to do all of these. And then the expense recognition principle says that we put the revenues in the same period, the expenses in the same period when the revenues occurred. So if we had expenses where we were generating revenues, we want to match those expenses with the revenues. That's the matching principle, putting the expenses and the revenues in the same time period in which they occurred. They talk about full disclosure principle. That's where you go through and you make sure that everything you have, you're giving information to users of the financial statements. So that's why we put a lot of extra information sometimes on the financial statements, the balance sheet and income statement. And then finally they talk about something called the cost constraint. And all that says is doing all this is great and it makes you more accurate, but it also takes more time and more money, because time is money. So you have to balance the information and being relevant and useful to somebody with the cost of creating that information. So it's kind of a mitigating standard. So we're always looking at the cost benefit. We don't want it to cost more to do something than the benefit we receive. So for example, that would be if you go through and you buy a delivery truck for $100,000, you record that as an asset and then you depreciate it over the next 10 years to match the expenses and the time period in which you were using the truck. However, if you bought a trash can for $10 and it's going to last for 10 years, you don't go through and depreciate it over 10 years at $1 a year, because it costs just as much to record the depreciation each year for a $10 trash can as it does a $100,000 delivery truck. But the information that you get from knowing the cost of that delivery truck is a lot more useful and beneficial than knowing that $1 for that trash can. So you always have to balance those out. So this is an important chapter. There's a lot of concepts here. So that's chapter 3.